Hi, I'm Sonia Munder, a tax director here at Wilson Partners. I specialise in UK tax and succession planning and in advising individuals and trustees on those tax matters. So today I'll be talking about trusts, what trusts are used for, the different types of trusts, how they're set up, and how to manage those and plan going forward. Trusts are still key in estate and succession planning. They're not just about tax, they are used to help protect family wealth for vulnerable or young beneficiaries, intergenerational transfers, and an overall tool for governance of family wealth. So one key message is that they need to be structured and administered correctly. There are lots of different types of trusts that can be used in estate planning, and choosing the right one is critical. It can depend on individual circumstances and objectives and what a family is looking to achieve in setting up that trust. The most common types of trusts we tend to see are discretionary trusts, which offer asset protection and flexibility, interest in possession trusts, which are usually set up, say, on death or used where income is needed for a beneficiary, but to retain that capital for another beneficiary, say, or bare trusts, which are generally used in nominee circumstances where you're holding assets, say, for a minor beneficiary. So the tax treatment of each of these trusts is different, and the right structure entirely depends on the family's objectives, their tax profile, and their long-term plans. Setting up a trust isn't just about drafting the legal trust deed. Things you need to consider are the assets that are going to go into trust, who the trustees will be, who the beneficiaries will be and how they're defined in that trust deed, whether the trust will be UK resident or non-UK resident, and the tax implications of creating the trust and the ongoing tax implications of running the trust. Other things to look at are working with legal advisors to ensure that the trust deed is set up with the objectives in mind, but also in a tax efficient way. So here at Wilson Partners, we don't just advise on UK domestic trusts, we also help our clients who have offshore trustees or where beneficiaries are non-UK resident, where they have assets set across multiple jurisdictions. We can help advise those offshore trustees on their UK tax position and the tax position of UK resident beneficiaries and settlors. These rules tend to be extremely complex, and having a professional advisor assist with those is crucial. So once a trust has been set up, it's important that it is managed effectively. What this involves is ensuring that things like the trust has been registered and the trust register continues to be maintained over the lifetime of the trust, completing annual trust tax returns if that's relevant, capital gains tax reporting, distributions to beneficiaries and ensuring that they have the detail that they need to report it on their own personal tax returns, and also inheritance tax implications, as the trust often has tax charges, say at every 10 years or when capital assets are distributed from the trust. Here at Wilson Partners, we can assist you with setting up the right type of trust for you, the ongoing management of the trust, so with the trust's annual tax compliance and the trust registration. We can also assist with tax efficient distributions and planning around that. We can help you plan as things change for the family and for the beneficiaries.